3 million.
Yes.
When you say qualify for 3 million, what does that really mean? Does that mean that as soon as I buy this policy, it means if something happens to me, God forbid, there's 3 million there that's there if I'm no longer around? Like,
that's right. That means it would
quantify
take
that
care of any beneficiary that you designate. Would get $3 million tax-free if something happened to you. That's what the $3 million means. It's not you have $3 million that you can borrow in terms of a loan or anything like that. Right. It's that is what the insurance company is literally guaranteeing that they will pay out to whoever you want. You know, it could be a charity, it could be spouse, children, anybody. You can choose whoever it is, and you can change that, by the way, anytime you want to. But the point is that's what the $3 million is. So let's just say, for example, you were 30 years old, earning $100,000, and you said, yes, I want to do a $3 million policy. Now, this is what I do. I reverse engineer the policy. Normally, what happens is people say, I want to put in the least amount of money for the most amount of life insurance. That's how people normally think of it. Least amount of money, most amount of life insurance. I reverse engineer that completely and go, okay, I'm going to teach you the benefits of putting the most amount of money in for the least amount of life insurance. So the first thing we have to do is determine your eligibility for being able to do this. So if I said, okay, you're 30, you make $100,000 a year, you can qualify for $3 million. Now we have to see how healthy you are. The main factor on health, believe it or not, is your height and your weight. That's the main thing they look at. Because if you are, they call it a BMI index, body mass index, right? If you're overweight dramatically, that's going to cost more to insure yourself, right? And so the healthier you are, determined by your body mass index and any prior health conditions that you have, the less expensive the life insurance would be. So for example, with a term policy, you might be able to get a $3 million term policy on a healthy 30-year-old for, I'm just guessing, $800 a year, maybe $1,000 a year, right? So I don't know exactly. These are numbers I'm making up off the top of my head. But I might be able to structure an infinite banking policy to put in $30,000 a year for that same $3 million death benefit, right? So I'm just going from $1,000 to $30,000, and somebody would go, why in the world would I want to do that? The reason is because you're building this wonderful cash value inside of your policy that you can then collateralize and have a line of credit, guaranteed, by the way, access. They cannot turn you down, so there's no financial requirements, no credit pulls, no nothing when you get this loan. It just comes to you in the form of a direct bank deposit within 5 days of you requesting it.